What do you mean by the Goldilocks of the three bulls?
Well, what I mean by that is we've had this obviously tremendous run in markets, rebound in the economy, and it's been driven by three big pillars of support. First, the Fed, as we know, and I talked about all week tapering, but the Fed is still very accommodative, zero rates, and even tapering is not tightening. They're still adding to the balance sheet after all. Fiscal policy, $5 trillion, and still counting, as you just touched upon. Albeit not as much as 12 months ago, but still supportive. And then the increasing freedom of moving around the economy due to the vaccines. But the real challenge is the recovery is occurring in terms of cash in people's pockets, demand, but not helping the supply chain disruptions at this point. So it's a big challenge, I think, for the Fed and the markets. You know, what happens with inflation, what happens with rates. But it's been three bulls driving the market up to now.
Yeah, it really has been. And you know, the supply chain things, and there's some moves at the ports yesterday. They want to stop them lining up. They're basically just going to shift the problem to somebody else. That's just going to take time. I think everybody kind of realized that. You only reopen once, to quote a few others who have said that before me. But when this does get shaken out, do you still worry about inflation, or is inflation kind of not a worry like it was in the 70s and 80s? Because money supply is so much higher. That's true.
I think it's, you know, the conversation seems so much about it being binary. It's either the 70s or it's 2%. It's, you know, to us, it's both. Obviously, parts of it are transitory, but parts of it may be stickier than we'd all would like. And the two things that we're watching carefully on inflation are wages and shelter costs. Those two components of CPI are north of 50% of CPI. And we see what's going on with wages. Obviously, there's a supply shortage of labor. And I would say, if we want to go back to the 70s, labor is probably in the best position to negotiate that they've been in since the 70s. We see strikes, you know, we see sign-on bonuses, we see it up and down the scale, not just for service industries, you know, Wall Street. So wages, very carefully watching that. It's been a frozen rope for decades at about 2%. Now it's peaking up to 3%. Shelter costs are another one. You know, we always seem to fight the last war or the last downturn. So the housing downturn in 2008, 9, 10, the result of that was underbuilding for nearly a decade now. So there's a shortage of supply given the demand. We see new home prices, Case-Shiller, I think, was 19% and change year over year. It takes about a year. There's about a year lag between when house prices go up and it embeds itself into the CPI number. Yeah. So, you know, we think inflation could come down to, well, not these 70s.
Before we let you go on this Friday, Cliff, I'm going to jump in. I apologize. Before we let you go on a Friday, I always like to have an opportunity. What do we buy now?
Sure. So we think the reopening is occurring, even if rates head up a little bit. Inflation's at 2 or 3%. That we should be focused on income-generating sectors and value. If you look at dividends, historically they've been about 40% of total return. This last 10 years, only been about 17%. We think that's going to revert. So we like the value sectors. We like banking, good dividends, low PEs. We like international stocks, lower PEs, recovering economy. Those are some of the things that we would reposition given where we're heading in the next 6 to 12 months.
Okay.